Welcome back to Ben's Book Club. Today we're diving into the book, Friends That Invest, Your Guide to Financial Independence Through Shares and Stocks. Simran Kaur, the author behind this phenomenal guide, has built one of the most downloaded investing podcasts in the world. How? By taking an incredibly intimidating topic and translating it into a language we actually speak. This updated 2025 edition takes what used to be called Girls That Invest and broadens the tent. It's an invitation for everyone to join a supportive community and learn a life skill that has, for way too long, been kept behind closed doors.
So why do so many smart, capable people feel like the stock market just isn't for them? Well, there's a massive systemic barrier keeping women, young adults, and historically excluded groups away from building real wealth. The financial industry has literally spent decades constructing this highly exclusive, impenetrable wall of jargon. It creates an atmosphere that makes brilliant people think, you know what, I'm just not cut out for this. But Simran Kaur makes it her absolute mission to break down this intimidating finance bro culture. She proves right out of the gate that you do not need a finance degree to get in on the action.
And the core philosophy here is crucial. Wealth accumulation isn't a status game about buying luxury goods or flashing designer labels, right? It's an engine for autonomy. Kaur completely reframes our relationship with capital. When you build a financial cushion, you are literally buying back your own choices. You're buying the power to walk away from toxic jobs, the ability to leave unhealthy situations, and the flexibility to choose work based on meaning rather than sheer survival. At the end of the day, money is just optionality.
To get that freedom, we have to take a hard look at our current habits. We often think hiding our money in a traditional savings account keeps it perfectly safe, simply because that little number on the screen never drops. But here's the catch. Inflation. Because of inflation, your uninvested cash is quietly losing its purchasing power every single day. Saving is kind of like keeping water in a leaky bucket. It's great for your immediate thirst, sure, but it won't water a whole farm. Investing, on the other hand, is planting those resources so they can actually grow and multiply over the long haul.
Now, you can't just throw your money into the market blindly. Before buying a single share, you gotta lay what Kaur calls the first 5 bricks to create an unshakable financial foundation. First up, you need to intimately know exactly what is coming in and going out. You absolutely must clear out expensive high-interest debt, like credit cards, because those rates will just wipe out any market gains you make. Then, automate your finances to remove human error, build up a rainy day emergency fund, and finally, sort out your basic retirement accounts. This foundation ensures that when life inevitably happens, you aren't forced to rage your investments.
When we see all those flashing red and green numbers on the news, it's so easy to assume the whole thing is just a giant casino. But Kaur shows us that true investing is about capturing long-term business value, not chasing a quick thrill. Speculation is sitting around hoping a price magically jumps by tomorrow. True investing? That's buying a piece of a functioning, profitable business, or even the broader economy itself, and letting it create real value over decades.
Okay, let's talk about Wall Street jargon, which is entirely designed to be intimidating. The actual solutions are incredibly simple. Enter the index fund. Listen, you don't need to sit at a desk staring at 6 monitors trying to pick the next hot stock. An index fund is a simple, passive investment that tracks a broad section of the market. By purchasing just this one thing, you instantly own a tiny slice of hundreds or sometimes even thousands of companies all at once. It totally removes the stress of trying to find the needle in the haystack because, well, you're just buying the entire haystack.
Kaur actually has a brilliant way of explaining this, using a peer-to-peer approach. She explains an ETF, an exchange-traded fund, by comparing it to the forgotten Jonas brother. Okay, hear me out. The flashy individual tech stocks, those are like Nick and Joe, right? Grabbing all the headlines and drama. But blended funds like ETFs, they're the Kevin of the financial world. They aren't flashy, they rarely make the front page, but man, they reliably show up, do the heavy lifting, and get the job done year after year.
Spreading your investments out like this introduces us to a massive, fundamental concept, diversification. Risk is absolutely unavoidable in any financial venture, but spreading your bets out rather than concentrating them all on a single company is the foundational secret to managing that uncertainty without completely panicking. When one sector of the economy struggles, another might be thriving. Diversification ensures your overall portfolio just naturally balances out those bumps in the road.
And understanding this mathematical risk leads directly into understanding your own psychology. It is incredibly vital to separate your math from your feelings. Look, temporary market dips are perfectly normal. Risk capacity is the cold, hard math, like how much of a drop can your overall financial picture survive without actually impacting your daily life. But risk tolerance, that is purely emotional. It's how much volatility your stomach can handle before you get scared and hit that sell button. Knowing your own emotional limits is what prevents the very real danger of panic selling right at the absolute bottom.
Because we all have totally different emotional limits, there is no single ideal way to participate here. Kosur invites you to pick an investor identity that perfectly matches your lifestyle, your time frame, and your personal values. Instead of pretending there's some magical one-size-fits-all formula, she breaks it down into 3 highly relatable paths: the lazy investor, the ethical investor, and the spicy investor.
Let's start with the lazy investor. For most of us, simple, repeatable systems easily outshine complicated intentions. This strategy leans entirely on automation and broad diversification. Basically, you set up a regular transfer to buy index funds or ETFs, and then you just go live your life. You check your portfolio maybe a couple of times a year. Making this a set-and-forget approach drastically reduces the friction of decision-making, making it the absolute most reliable path to consistent wealth for the average person.
Now, if your principles are non-negotiable, you might lean toward being the ethical investor. You can absolutely align your capital with your morals by screening for environmental impact, fair labor practices, or strong corporate governance. But a quick heads up here, Kaur rightfully warns that this path does require careful research. You really have to look deeply under the hood of these funds to ensure you aren't just falling for corporate greenwashing, but actually genuinely supporting causes you believe in.
And then, for those who actually enjoy the research and love the thrill of picking individual companies, we have the spicy investor. But the brilliant advice here is all about containment. You keep this higher-risk, active strategy strictly isolated to a small, controlled portion of your portfolio. Think maybe 5 or 10%. That way you get to scratch the itch and have fun with the excitement of single stocks, while totally protecting your broader financial foundation from any major losses.
Even with all these strategies laid out so clearly, an incredibly important question remains. Why are so many people still sitting on the sidelines? We really have to recognize that the lack of participation from women and minority groups isn't about intelligence, and it definitely isn't a lack of capability. It's rooted in deeply ingrained cultural hurdles. We're talking massive social conditioning, unequal access to basic financial education, and this profound cultural discomfort we have around discussing money openly. There is an undeniable confidence gap created by historical industry gatekeeping.
As Kaur points out, the entire finance industry has historically benefited when everyday people just remained disengaged. Think about it. If you believe it's way too complicated, you'll either pay exorbitant fees to an expert to manage it for you, or you'll just stay out entirely. That is exactly why translating these concepts into plain English isn't just about financial literacy, it's a powerful act of reclaiming agency. You have exactly what it takes to understand this stuff.
One of the biggest myths holding people back is the stubborn belief that they need to wait for a market crash or wait until they have some massive lump sum of cash to begin. Waiting for the absolute perfect moment to jump in is a massive trap, simply because you cannot predict the future. Harnessing the true power of compound interest means that starting early almost always beats waiting around to invest a large lump sum. Your money needs time to grow, earn dividends, and then have those dividends earn more dividends. Time in the market always beats trying to perfectly time the market. To help overcome this hesitation, there's a brand new chapter in the 2025 edition that focuses entirely on a very realistic, concrete goal. It is dedicated strictly to actionable steps to confidently invest your very first $1,000. And it's not that 1,000 is some magic number. It's about shifting your mindset away from theoretical learning and moving into active physical participation. It's about finally getting off the sidelines. Starting small absolutely does not mean thinking small. It's really about converting all this newfound knowledge into immediate, friction-free behavior. You choose that diversified ETF. You set up an automated transfer. You commit to a long-term horizon. And you strictly tune out the hype of the 24-hour news cycle. Most importantly, you build a system that operates steadily despite market noise. And yes, that means putting the phone down and not checking your portfolio every single day. Remember, your first investment is simply financial education. And hey, you're already doing that right now. But education without action is really just trivia. So, challenge yourself today to stop over-preparing. Clearly define your goals, check those first 5 foundational bricks, and go open that brokerage account. Don't wait until everything feels perfectly aligned, because let's be real, that day will never come. The power is entirely in your hands to build the freedom you deserve. Take that small, concrete step this week and plant the seeds for a future with more choices, more security, and total autonomy. After all, what is the true cost of leaving your future entirely in someone else's hands for another whole year? I hope this explainer of Simran Kaur's framework has demystified the process,
and giving you the confidence to just start. Thank you for joining us, and subscribe so you don't miss an episode.